The market does not have any preference for any particular political party. Market wants political stability, but if that happens, there will be a big crash in the market. No doubt about that. There can be a more than 20% crash in the market.
Welcome to Geojit Spotlight. Geojit Chief Investment Strategist Dr.V.K Vijayakumar joins us to share his views on current market scenario. Welcome, sir.
Thank you, Abhilash.
So, market is very bullish. Nifty and Sensex have set many records this year. Is there any scope for further rally from the present level?
The market, yes, it is very bullish. Last year, Nifty delivered 20% returns. The mid and small caps delivered 46 and 55% returns respectively. This year, on top of the 20% returns in 2023, so far, year till date, Nifty is up by another around 3%. So the market continues to be bullish and resilient. But the answer to your question, is there scope for further rally from here? The answer is not very simple. To answer that question, we should understand the nature of this market and also the trend of the market. So let me summarize it for our audience. First, this is a global rally. It is important to understand that stock markets are globally highly correlated. The correlation is around 98%. And globally, markets are doing well. The performance of the mother market, US, is very important. And in US, Dow Jones, S&P 500, and NASDAQ are at record highs. Most of the European markets are at record highs. Japan, after many years, more than 3 decades of stagnation, is now at record highs. So there is a global support to the rally, and that is very favorable. Second, coming specifically to India, India's economic and corporate earnings fundamentals are very good. A market will not rally without fundamental support from economic growth and corporate earnings. That is hugely important. So now India is, by global consensus, the fastest growing large economy in the world for 3 years in a row. And this year, the GDP growth rate is expected to be 7.6% against the 7.3 and 7% expectations at the beginning of this financial year. Corporate earnings are decent, so there is fundamental support to the rally. Third, flows into the market. Capital flows into the market are robust. The explosive growth in the number of demat accounts continues. Now it is more than 13 crores. And the flows into the mutual funds, SIP monthly flows is now around 19,000 crores, 18,838 crores in January. All this will support the market, will impart resilience to the market. But the concern is valuations. Always investors should have the valuation concern at the back of their minds, because at high valuations, some negative trigger can cause sharp corrections in the market. Now, India is the most expensive market in the world now. If you look at the price earning multiple for this financial year, FY24, the PE is around 22, more than 22. The Nifty is trading at more than 22 times FY24 earnings. That is expensive valuations. But these expensive valuations can continue, but then I would say the scope for further sharp rally from the present levels, taking the Nifty to 24,000, 25,000, that is not likely in the near term.
So what are the prospects for a pre-election rally and how will the general election impact the market?
Well, elections are hugely important. If you look at the performance of the market in the run-up to the elections, during the last 5 general election years, 2019, 2014, 2009, 2004, and 1999. In all these 5 general elections, just before the elections, there has been a pre-election rally. This is based on expectations regarding the election outcome. It has always happened. Therefore, this time also we can expect a rally, but that rally is already happening. I would say that the part of the pre-election rally has already happened. For instance, on December 4th, after the uh, four state assembly elections results were announced, market opened on Monday, December 4th, with a gap up of 1,348 points on the Sensex. There was more than 2% rally. 2% rally in one day in response to the election results means the market had already discounted, already started discounting the outcome of the election results. Now, first, let me make one point very clear. The market does not have any preference for any particular political party. Market wants political stability, continuation of market-friendly economic policies, and continuation of reforms. I'll give you an example. In the general elections of 2009, the election results were actually a little bit of a surprise. The UPA government, under the leadership of Manmohan Singh, came back to power with a sizable number of seats, and they were in a position to rule the country without the support of the left. Left was the major factor standing in the way of economic reforms. And therefore, when the election results gave a thumping majority to the UPA minus the left, the market opened gap. There was a circuit on the index after the election results. When the markets opened after the election results. So the market does not have any preference for a particular political party or a political coalition. Market wants political stability. Of course, if we have a government, a politically stable government with a very strong leader, a very charismatic and powerful leader, that can certainly impart more resilience to the market and strength to the market. And it is a fact that Prime Minister Modi is by far the most charismatic leader. Of course, there is strong opposition to him also, but then he is by far the most popular political leader in the country. Therefore, if the ruling government, BJP government, the NDA government, comes back to power, that political stability will be appreciated by the market. And now, I think a big difference between the rally in the run-up to the elections this time and the rally in the run-up to the elections on the previous 5 occasions is that now there is more clarity, there is no likelihood of any election upset or unexpected election outcome. But then politics is politics. Anything can happen. If some unexpected developments happens, as Harold Wilson famously said, 1 week is a long time in politics. Therefore, if something happens and let us say the INDIA alliance comes to power, it's a remote possibility. I would say it is a less than 5% possibility. But if that happens, there will be a big crash in the market, no doubt about that. There can be a more than 20% crash in the market because a new coalition, that coalition will be a weak coalition and politically unstable, economically unstable, and they will not be in a position to push reforms. The market will not like it, and the market will react strongly. So that is about the political background.
Recently, the market regulator SEBI has sent an advisory to mutual funds flagging the excessive valuations in the mid and small cap segments. What will be the impact of this on the mid and small cap segments?
This is a concern, an important concern in the market now. We have been sharing this concern and sending messages to our clients also that the broader market is now overvalued. There is a specific reason for that. If you take the last 1 year, 3 year, 5 year, 7 year, 10 year, any time period, the small caps and the mid caps have outperformed the large caps. So the investors, particularly the newbie investors who have come to the market during the last 4 years, they are more influenced by the recent developments. So small caps and mid caps are outperforming large caps very consistently. So put the money in small and mid caps. It appears to be a rational thing to do. That is a rational response. But then it is very important to understand the significance of valuations also. Now the valuations of mid and small caps are very excessive. I think SEBI has even used the word frothy valuations. And some mutual funds have sent out messages like that. Many mutual funds, small cap mutual funds like Nippon Small Cap Fund, Tata Mid Cap Fund, a few other mid caps, and recently Kotak, a small cap fund. All these, I think Tata's it is small cap fund, not mid cap funds. Mid caps funds continue to accept money, but these small caps funds, Tata's, Nippon, and Kotak, have stopped accepting lump sum investments into their small cap schemes because the valuations are hard to justify. The problem with high valuations in these segments is if there is a correction in the market, there is a sharp correction, let us say there is a 10% correction in the market, then the small caps will correct by 30%, 35%, even 40%. That has happened in the past. Even in a very strong bull market, like for example the 2003, 2008 beginning a bull market, where the Sensex multiplied more than 6 times in 5 years. Even during that mother of all bull markets, we had corrections of more than 15% on 6 occasions, right? So corrections are part of the rally. So if you have a correction of, let us say, 10%, and the small caps correct by 30%, the problem is a person who puts in a lump sum investment of 1 lakh in the small cap fund will find his investment decline by 30% from 1 lakh to 70,000 rupees. That is the risk. That's why the SEBI has suggested to the mutual funds. AMFI also has shared this concern. So the SEBI's suggestion is to the mutual funds to put in a framework to protect investors in the event of a sharp correction. So that is why they have stopped lump sum investments, and it is quite possible, also possible, that they might put a limit to the amount of systematic investment plans, SIPs also, because otherwise this will become excessively frothy and very dangerous. So also it is important to understand that at this juncture in the market, when the Nifty is above 22,000, this is the time when safety is more important than returns from the market, because in this broader market the returns can be very risky, it can be negative, and therefore investors should give priority to safety now, and that's why everyone says now that safety is in large caps. Therefore investors should give priority to safety rather than chase the returns, big returns from small caps and mid caps, because small and mid caps cannot continue to outperform on a sustained basis all the time. That is not possible.
Thank you, sir. Thank you very much.